3 years into day trading and I still had no idea where to start. That's exactly why I lost money for 3 years. It was never the market, guys. Nobody gave me the order. 8 years in and I'm a consistently profitable trader. So here's the roadmap that I would follow if I started trading from zero tomorrow. There are 8 steps. The one thing that you should do before you ever touch a chart, 3 ways how the market actually moves, and the last ingredient that sets up everything together and makes it mechanical. Okay folks, here's the first thing that you need to do, and that is to learn the language of the market. Imagine you are a kid. What do you do first? You go to the primary school and learn everything. What's the name of stuff? What is that? How this works? Everything. It's just a base knowledge before you go deeper into the different subjects later on in your life. The same works for trading. You have to learn what is a pip, what is a lot size, what is a MetaTrader, trading view, what is a high impact news, NFP, when you have to trade, when you don't have to trade, what is the indicator, what are the sessions. So all of that technical stuff. First thing that you do ever before you touch any charts is to learn the technical stuff. And for that, it's quite simple. There's a free website, free resource, babypips.com. You just go into that website. There's a school of Pipsology. I have read that at least 3 times. So no shortcuts, guys. It will literally take you from zero, knowing nothing about trading, to the pro level where you will be able to open the trading view, open a MetaTrader broker account and start placing your trades. But of course, the very next thing that you're gonna do after learning the basics on the baby pips is going to exactly pass out the future road for yourself, what kind of trader you're gonna be. The very next step after learning the basics, you have to choose what type of trader you are. And that type of trader is gonna tell you what charts you're actually going to trade. Because the beginner traders who come into this market, they're gonna go and look for different strategies. They will not make the distinct differences between a scalper, day trader, swing trader. They will just go and try everything. Let me be a day trader on Monday, and you're a scalper by Thursday, and on Friday you're placing some swing trades because the market is going to sleep. So it should not be like that. Most importantly, you should not live around the trading. You have to build your trading around your own life, your existing schedules, not the other way around. And in that case, because you might have different schedules, you might have a day job, you might have after classes, you might have a night shift, you might have, I don't know, anything. That is why the type of trader you want to be depends on your schedule. Okay, here's what you have to do. There are 3 types of traders: scalpers, day traders, and swing traders. And I want you to choose one of them, like one of them between them. And there are actually pros and cons that I will talk about a little later, but let me tell you first about the scalpers. To be a scalper, you have to be able to carve out at least 2 to 3 hours a day for trading. If you can't sit in front of the charts for 2 hours a day at least, every day, 5 days a week, scalping is not for you. If you want to become a day trader, you only need 15 to 30 minutes a day. That's all. If you want to become a swing trader, you just need 15 to 30 minutes a week. And you might be thinking, okay, why do I need to become a day trader or a scalper if I just can spend like 15 minutes a day, 15 minutes a week for trading? That comes down to the level of patience you have. Because if you're a scalper, you're gonna take like probably 5-6 trades a day, because there are different sessions. If you're a day trader, you're gonna take a couple of trades a day. If you're a swing trader, that is very slow way of trading. You're gonna take only 2 to 3 trades a week probably. Or some weeks you're not gonna trade at all. That is why it comes with a price. If you're ready to wait for so long, you can become a swing trader. But the sweet spot, I believe, is day trading, where you're gonna take just a couple of trades a day and you're gonna spend just a couple of minutes a day. That's a sweet spot for most of the people because you take trades almost every day and you don't spend much time. Okay guys, there's one more thing that I have to tell, like this is a biggest lesson, biggest takeaway from this part, from the step 2, is once you choose the type of trader you are, scalper, day trader or swing trader, there are specific time frames that you have to stick and trade on based on the type of trader you are. For the scalpers, that is going to be 3 to 5 minute time frame. All of your analysis, all of your entries, everything must be done on that time frame. You don't need the higher time frame or lower time frame. If you're a day trader, your time frame to go is a 15-minute time frame. You don't need daily, you don't need weekly, anything. All of your analysis, all of your entries are inside only one time frame. If you're a swing trader, your time frame for the execution is going to be 4-hourly time frame. Now, you know what type of trader you are, how much time you need, and on what time frame you should take all of your trades. The next question that comes is, what do you actually have to look at? What is the price? What is the charts are actually telling you? This is exactly what we will cover in the next step, and I want to take you to the whiteboard. Okay, folks, the market does only 1 out of 2 things that I'm going to show you right now. And if you can't tell in which stage the markets are right now, none of the strategies are going to be effective for you. So what does the price do? The price trends, and at some point, the price is going to go into the rangy market when it's neither going up, neither going down. Sometimes it might go up, sometimes it go down. So there are 2 different market conditions. It is either trending or it is ranging. This cycle is never going to end. The price cannot trend forever. At some point, it's going to get exhausted and transition into the range. And the range will not last forever. At some point, it is gonna get so compressed that it will burst either to the upside or to the downside. So before taking any trade on any strategy, the first question that you have to ask yourself is in which stage the market is right now. And that is simple. There are millions of different ways of identifying that. You can use the moving averages, you can use some indicators, you can use, I don't know, whatever. But the most effective way of identifying the market is to read the bear charts and look at the highs and the lows of the price, what the price is doing. Let's say you're a swing trader, you're reading on the 4-hourly chart. If the price is making the highs that are higher than the previous ones and the lows that are higher than the previous lows, that means that the price is going to the upside. Again, if the price is making consistent pushes and pullbacks in one direction, consistently making higher highs, consistently, that means we're in the uptrend. If the price is making a consistent lows that are lower than the previous ones, that means we are in a downtrend. Of course, with the highs that are lower than the previous ones. If the price is making neither, it's making higher high, then higher low, then lower high, lower low, etc. So there is no consistency in the price action. You can just see that on any chart. You just open the trading view. So answer this question first. Is the price trending or it is ranging? And here's the interesting part, guys. 90% of traders lose all of their accounts, even if they answer this question right. Why? Because 90% of them, knowing the state of the market, they will still keep using the same strategy for the different market conditions. This is an interesting part because most strategies are fail not because they are wrong, but because you're using different tools that don't fit the existing market conditions. For example, the range trading strategy is going to get chopped, is going to get broken, obliterated during a trend. And the trend trading strategy is going to get chopped during a range. Like asking a trend trading strategy to work, it's like asking the fish to climb the tree. And asking the bird to swim under the water is like asking a range trading strategy to work best on the trendy market conditions. So guys, none of the single strategies are going to perform well in different market conditions. And coming out of this, you need at least two strategies. One strategy is focused on trading the trend, and the other strategy is focused on trading the range. It's like having a t-shirt for the sunny day and coat for the rainy day. Like, you're not going to wear something warm during the summer, right? So different tools, different strategies serve different purposes. Remember that. Now, talking about the tools itself, the different strategies are going to give you the different entry models. So the first question, any strategy that you're gonna use, have to answer this question. Where do you actually get in? And guys, and what models that you're gonna use to get in? And guys, there are only 3 ways for that. Okay guys, here's the interesting part. Traders are going to burn years of their life hopping the strategies, changing the strategies, choosing different strategies, not knowing that all of the strategies in the world, I can bet with you, they're all built on the same principles, on the 3 core entry models. Nothing different from that. So there are only 3 of them. The first is the breakout and retest model. For some time, the price is going to range inside of the range, and the price is going to burst in one direction and then make the breakout and retest the range. It is like, again, first we told you, there are only 2 markets in the market. The price is going to range and is going to trend, right? So the range will not last forever. So for this strategy, you need to find the right range. That's a 90% of your success, and wait for the price to break out, retest, and enter the trade. And there's a second way of entering the market, which is actually, for example, it's good for trading the trends as well. It is supply and demand. Let's say the price is making higher highs and higher lows. You just follow the price and you enter on the supply and demand levels. So there are thousands of different strategies with different names in the market that trade the supply and demand levels. So this is a second way, the second model that builds all of the strategies in the world. And the third way of entering the market is the liquidity grab model. When the price is taking the liquidity above some high or low and reversing to the opposite side. This must be a key level that holds a lot of liquidity behind that, and this might be used for in a ranging market conditions. Let's say the price is ranging and you're gonna see some highs are going to get swept and reversed, or the price is going, like, let's say it was trending and at some point it enters the range, it sweeps the highs and reverses to the downside, etc. So this is used in rangy market conditions most of the times, or where the price is doing the transition from the from the uptrend to the downtrend, or from the downtrend to the uptrend. So what I would suggest you is to pick one of those 3 entry models, go deep, not wide, and you have to master it completely. Exactly, like it would be better if you do that on a single pair. That would be even better. So you master it, go deep, and then you start learning the second, the third, and you start combining all of them. That's going to give you the best risk-reward ratio trades, the best win rate across all of the market conditions, and you will be able to trade different markets at different times. Okay, folks, now you know where to enter, but entering at the wrong time, with the wrong momentum, with the wrong direction, it's just still a loss. And everyone uses the same tool for the direction, which is a market structure, which is I have explained to you as well, but using that for knowing the direction of your trades is still backwards. Let me explain. Market structure is like the rear view mirror. Like, you are already looking at the price action that has already happened, not what's happening right now. Like, the price is just going to the upside. It was going to the upside, right? Of course, the trend is your friend, etc. That's true. Trading in the direction of the trend is true as well. But in reality, let's say the price is going up, right? We do have the pushes that are going to the upside, and we do have the pullbacks to the downside, which are against the trend, right? So basically, there is such a thing as momentum. In an uptrend, you might have a bullish momentum and a bearish momentum, bullish momentum and a bearish momentum. So you need to trade in the direction of the momentum. Momentum tells you where the speed is exactly right now. Without a mechanical entry is just gambling. You need both. You need the momentum and you need the mechanical entry that we have talked before. So how do we actually know the momentum? Let me give you an actionable tip how to do that, and you will be able to start using that right today. And for that, you need the higher time frame. It's interesting. I've told you that you only need one time frame. Of course, that is 100% true, but only for your analysis, for your entries. So the trade itself is going to be built only on one time frame. But you need the higher time frame to know the momentum. How we do it? For the scalpers, let's say it's a scalpers, your higher time frame is going to be 4 hourly time frame. Let me give you the higher time frame reference, and then I will show you how to do actually that. For the day traders, it's going to be the daily time frame. For the swing traders, that is going to be a weekly time frame. I hope this is clear. So what do? We enter on the 5-minute time frame, but our higher time frame is 4 hourly. We're going to enter on the 15-minute time frame, but our momentum time frame is 1 daily time frame. And for the swing trader, it's a weekly time frame. Don't understand me incorrectly. You will not use any levels. You will not do any analysis on the higher time frame. You just need one thing. And that is quite simple. You will read the candlestick patterns. You just need to look exactly at the last 2 candles. Let's say for the day traders, you go to the daily time frame and you look at the previous 2 candles. Let's say you have one bullish candle and another bullish candle. This means that momentum is bullish, that the third candle, the next day, the current candle, today's candle, is going to close bullish as well. That's it. That's how simple it is. And the same applies for the bearish. If you have one bearish candle, the next bearish candle, the third day is going to be bearish as well. At least the statistics shows that this stuff has an edge over the markets. And I can confirm that as well. So how do we know about the reversals? Let's say we do have the bullish candle over here, and the next day candle is bearish. That means it's a reversal, and that means today's candle might be bearish as well. The vice versa for the bearish one. The bearish candle, bullish candle, potential bullishness. And there's one most important thing. The second candle must close above the wick of the first candle, like this one. If it's going to close like this, let's say with a wick, that means as well that the next day is going to be, like today, is going to be bearish as well. It gives you the bearish momentum. The vice versa for the bearish candle as well. So this is exactly how you find out the momentum. Look at the candles. Look at the candlestick patterns on your reference higher time frame level. Just write it down, and I promise you, this is going to double your win rate. Let me get rid of this stuff. Let me bring it back. Okay, now you might be thinking, I know the direction, I know the entry patterns, I know the momentum. Now I can take the entries and I can trade all day long. And this is exactly where the 90% of traders again fail, the remaining of the 10%. So people overtrade, not because they want a revenge trade, not because they're greedy, or not because they're undisciplined. This is exactly only why, because they don't know the number of trades they are supposed to take. And one more thing, it is like they don't know when to trade and how many trades they take, right? So it's like, imagine you said you're gonna fast. You're gonna not eat for the next 3 days. And you took yourself a pineapple pizza, put it in front of your eyes and sitting and staring at that pizza and saying that you will not eat it. That's the exact thing what happens when you sit in front of the charts and say yourself that you're not gonna trade. Trading is a dopamine-rich activity where every next bet, it feels like it's just gambling. It's some sort of like, So if you will be exposing yourself to trades all day long to the charts all day long, you will take the trades. It's not about the discipline. You just need to take less trades. You need to expose yourself less to the charts. You need to build up the environment where you will not take trades, where you will just take a couple of trades a day and that's it. And guys, you should know your numbers as well. The scalper is gonna take 1 to 2 trades per session. So let's say for the Asian session, 2 trades, for the London session, 2 trades, for the New York session, 1 trade, and overall you're gonna take like 4, 5, 6 trades a day. For the day traders, that number is going to be 1 to 2 trades per day. For the swing trader, that is going to be 1 to 2 trades per week. And I've told you at the beginning, right? The difference between the swing trader and the day trader, that it's not like you just spend 15 minutes a week and that's all. The drawback comes down to the 2 trades per week. That's awful. So my advice to all of you, not all the sessions are built equally. Some are going to be quieter, some are going to be more volatile. And in the trading space, the Asian session and the Australian sessions are the quietest time of the day. And all of the liquidity, let's say if we're talking about the Forex and even about the stocks, it comes down to the opening of the London session and New York session. So ideally, you have to be spending like 15 to 30 minutes a day for day trading during the open, even for the scalping, at the open of the London and at the open of the New York session. You just open your charts on the 15-minute time frame. If there's a trade, you're gonna take it. If there's no trade, you're not gonna take it. And as I told you, cap your trades to 2, just 2. Let's say, if you look at the markets, you might be thinking, okay, the opportunities in the market are limitless. When in reality, that's a lie. The opportunities in the markets are capped, hard capped. It's the source is not just trust me, bro. I will give you the real evidence, logical evidence. I will prove it to you just in a minute. Just make sure to watch this video till the end. So you have to cap your trades only to 2 trades a day. The moment you know why, your overtrading will just disappear forever. So all of the things, all of the 6 steps that we have covered, your take profit, your win rate. So after 2 trades, you just need to close your laptop, win or loss, whatever, and leave the charts and come back the next day. And here's the thing, all of the 7 steps that we have covered today is going to fail without the last ingredient. And this is exactly what turns any system from just a subjective system to 100% mechanical, rule-based system. Okay, folks, here's the thing. You need to make it 100% mechanical. Because all of the 7 things that we have covered today, it all leaves one gap. And when the subjectivity comes into the play, you're just back guessing again. Because which level you're gonna mark up, which range you're gonna choose. As I told you, like choosing the right level, choosing the right range, choosing the right supply and demand is the key for making it everything click and making it work, making it mechanical. So how do we actually do that mechanical? Because if you only by a mechanical strategy, only by a rule-based strategy, only by doing the same thing over and over again, you're gonna get consistent results from the markets. You cannot expect like taking decisions based on your gut feeling and expecting consistency. No, only the consistency brings the consistency, not the gut feeling, different results. I'm gonna take trades like this today, different tomorrow, or this stuff didn't work today, I'm gonna change it, tweak it, etc. No, we have to make it 100% mechanical. So what do we have to do for that? And that is, we have to introduce the time element into our trading. We have to tie up all of the levels that we have, all of the ranges, all of the supply and demand levels to the exact time. Because if the starting point for our trading is the same for you, for me, and for anyone else, the end result is going to be the same as well. This might sound a little vague and fuzzy for you right now, but let me actually explain that on a real example. So I've told you, like we have the 3 entry models, right? Let's start with a breakout and retest. how we're going to introduce the time element here and make it 100% mechanical. And also I will explain you how it is possible for us to only have 2 trades a day, like as a day trader. Just think about that. We trade that and we call that ARB strategy. You can check out the other videos on this YouTube channel and you're gonna find the videos about the ARB. What is ARB? We identify the first 4 hours of the Tokyo session, Asian session. As I told you, the different sessions are different. The Asian session is the quietest time of the day, and the London and New York are where all of the liquidity, all of the manipulation, all of the movement happens. So, what is a quiet? What is the alternative? That's a range in terms of the price. The price ranges during the Asian session and then trends during the London session. So we take the first 4 hours of the Tokyo session. The first hours of the Tokyo session, the price action during of that, we just open the charts at the beginning of the London session, we look at the back, we identify the first hours, we draw our high and low, and we wait. We wait for the breakout and retest either to the upside or to the downside. There's only 2 possible trades a day. There's only 2 possible scenarios. And since we're starting out exactly the same, you, me, and anyone else have the same range, the setups are going to be the same. Even your grandma can learn that and take the same trades as we do. We wait for the breakout. Let's say we do have 1 breakout to the upside and 1 breakout to the downside. The retest and gone. If it's a win-win, if it's a loss-loss, like let's say the price broke to the upside, broke down, and again breaking the second time to the upside, that doesn't work. We just trade the first breakout out of the Asian range. So it's the same for anyone. The strategy becomes 100% mechanical. There's the orb strategy. Probably it's trending on the internet right now. You just take the first 15-minute candle on the open of the New York session and trade the same breakout and retest, or just enter on the breakout. That's a more scalping strategy. So this is how it works for the let's say for the ARB, for the breakout and retest. Let's talk about the liquidity strategy. How do we make it mechanical? We take the levels that are tied up to the time. The previous day high, previous day low, Asian session high, Asian session low. We wait for the price to manipulate those levels. The previous day high, previous day low are the same for you, for me, and for anyone else, for everyone. Asian high the same for you and me. We just wait for the price to go, manipulate, and reverse. This is how you're gonna trade 100% liquidity levels. For the supply and demand, it's the same. Maybe the supply and demand is not going to be tied up to the specific time, but you can look for supply and demand levels during a specific time, inside of the specific time reference. For the day traders, we do that inside of the previous day candle. Every level, everything older than that is just irrelevant anymore. You don't trade it, you don't look at that. You just look inside of the previous day candle and use all of the levels that is presented inside of that and trade it today. So there's going to be only a couple of handful of levels, and they're all the same for you, for me, and for anyone else. And we have filtered out 99% of the fake levels. How good is that? So guys, this is the exact process I use to find 1 to 2 high quality trades every single morning without guessing my trades or being glued to the charts. And if you want to learn more about that, check out the first link in the description below.